Welcome to another episode of Finance, Facts and Fiction. In the previous video, we've discussed what diversification is, but also why we want to apply it in our investment portfolio. Now, in this episode, I want to discuss what common mistakes are when it concerns diversification, but also what is one easy way that we can get diversification in our portfolio without much effort. Now, before we dive into the topic of today, let's just briefly recap what we've discussed in the previous video. We said that diversification is spreading our investments over different assets. Now, the benefit of diversification is that we can reduce risk while we keep returns constant. And this is good. So the example that we had was that we invested in 3 different stocks. And in our total investment portfolio, we then obtained an average return, but with a low risk level. Now, we also discussed why this diversification benefit exists. And the reason is that individual stock fluctuations might cancel out because stocks not always move together. Some might go up while others go down. We had the example of the umbrella company and the ice cream company. When the weather is good, ice cream sales will go up. But if the weather is bad, umbrella sales will go up. So by combining the both assets, we can actually stabilize our growth, but reducing our risk. Now, what we also mentioned is that this company-specific or industry-specific risk will be diversified away, but what we're left with is called market risk. And that's something that we cannot diversify away. Now, the general fact that we reduce risk, but keep returns constant is a good thing. So we want to be diversified, at least most of us. Now, the problem is that sometimes we think that we are diversified, while in fact we are not. We make these small mistakes in our investment portfolio, or are just unaware about hidden correlation between stocks, or stocks that actually move together, even though we think that the returns are unrelated to each other. So that's what we're going to discuss next. And the reason for that is that we often make these 5 common mistakes, which we'll go through in detail one by one. But as a result of these mistakes, we are taking on too much risk in our portfolio, while in fact we can lower our risk while maintaining our returns. So let's try to do that. First, let's start off with the home bias. Now, the problem of the home bias can be exemplified as follows. I'm Dutch. So if I'm going to buy individual stocks, I'm likely to buy stocks of companies that I know, and this is called familiarity. Now, but it's even more likely that I'm going to buy stocks from companies in my home country because these are also the ones that I know, and this is called the home bias. Now, as a result, I'm buying a lot of assets or stocks from the Netherlands, but as a result, I'm under-diversified. So the 2 questions that you should ask yourself: do you own a stock from your own home country? And if so, do you also own stocks from other countries in a similar way? Now, it may not even be that you own stocks from your own home country, but it could also be that you only own individual stocks from, for example, US companies, because these are the often very large companies that are globally well known. But then the problem is that because you're only focusing on a specific geography, you're underexposed to market developments in other geographies. So, in this case, you may be under-diversified. And the solution to this is to invest in global markets. The second problem is investing in stocks that move together. And this may come in 2 forms. First, let's go through the example where you own 30 different stocks, but all stocks are in the same sector. For example, you're invested in Apple, Microsoft, and Nvidia, and other companies in the Nasdaq 100. In that case, if the tech sector crashes, all your stocks will drop in value. So you have very high exposure to the tech sector. The second mistake is investing in different stocks with similar in-the-line risk. For example, you may decide to invest in hotels and airlines, which look at the face of it as 2 completely different types of stocks. But the reality is that both depend on travel. And if travel restrictions are in place, such as during the COVID pandemic, then your entire portfolio may drop in value. So again, in these 2 cases, we're actually not reducing our risk since our stocks move together. So we're under-diversified. Now the solution to this is spread your investments across sectors, but also try to spread your investment across stocks that react differently to market events. The third mistake is adding too many assets and naive diversification. Now, adding too many assets may seem weird when we're talking that there are diversification benefits in place by buying different assets. However, we already know from the previous video that the diversification benefits are the largest in the beginning, so when we move from 1 to 50 or from 50 to 100 stocks, but they become smaller and smaller with each stock that we add. So if we go from 1,000 to 1,001 stocks, then the diversification benefits are not that big anymore. Or the additional risk reduction that we create is close to zero, while we still pay for trading fees or we add additional complexity to our portfolio. So as a result, it may not be worth the pain of going through another round of diversification. So diversification benefit may at one point not outweigh the cost of diversification. What you can rather do is focus on quality instead of quantity. So focus, with the two earlier mistakes in mind, on spreading your investments across different geographies, sectors, and stocks which react differently to market events. Now the second problem is related to just dividing your capital equally among stocks. For example, you decide to invest in 10 different stocks and you give each a 10% weight in your portfolio. But it may be that some assets are riskier and do not fit your investment profile that much. In that case, you should have given those stocks a lower weight. So what's the problem? Well, in this case, you're overexposed to high-risk assets. So you want to think a little bit about which assets deserve a larger share in your portfolio. Now, in this example, the alternative may also be true, where you may be underexposed to high-risk assets when you have a lot of low-risk assets in your portfolio. The fourth common mistake is ignoring other assets or ignoring your entire wealth. So let's start with the first. Only focusing on stocks may be a too limited view. You should also consider investing in bonds, commodities, and other assets, maybe cryptocurrencies. Because if we don't, we may be under-diversified in our investment portfolio. A lot of stocks may move in the same way, but it could be that certain types of bonds are very much unrelated to the stocks in your portfolio, and the same is true when maybe combining commodities with stocks or bonds with commodities and other assets. So we just want to think about all the investment opportunities that we have and then think about where the biggest diversification benefits lie. Now you may invest in different types of assets and how much you invest in the different types of assets depending on your investment profile. So for example, when you're younger, you may decide to invest more in stocks and relatively less in bonds, whereas as you grow older, you may decide to invest more in bonds and less in stocks. Similarly, for people who are worried about financial crises or crash risk, it may be good or smart to invest in certain types of commodities which are a better hedge against these types of risks. Or in some cases, people are worried about inflation, and certain types of commodities are again a good inflation hedge. So in certain cases, it's very important to consider other alternative investments which are not stocks. The second problem is not considering your total wealth. For example, income from your salary or real estate that you own. Now to exemplify this, imagine that you're the CEO of a technology company. Then in that case, you should actually hold less tech stocks since your income and job already depends on that sector. So for example, if the technology sector were to crash, in that case, you may earn a lower bonus or you may lose your job entirely. In that case, it would be very unfortunate to also see your investment wealth decreasing. So that's why it's important to consider the diversification benefits from your entire wealth, and we want to consider how our stock portfolio or investment portfolio moves with respect to other portions of our entire wealth. So this could be the real estate that we own, but also the income and the job stability that we prefer. So in this case, it may be that we're under-diversified in our total wealth. And what we actually want to do is consider not only our investment portfolio, but our full financial picture. Lastly, sometimes we forget to rebalance, and this may be a problem. Because over time, some investments in our investment portfolio may grow faster than others, making your portfolio unbalanced. For example, you now hold 70% in stocks and 30% in bonds and other assets. It may be that after a few years, stocks have performed exceptionally well, and as a result, you're now invested 85% in stocks and 15% in bonds and other assets. So in this case, we're taking on more risk than we had planned or prefer. So what we actually should be doing is rebalance our portfolio. And this means selling and buying assets to bring our portfolio back to the preferred risk return level. So in this case, we may decide to sell some stocks and invest a little bit more in bonds. Now, a similar problem may exist not only when comparing our investments in stocks and in bonds, but they may also exist when we're thinking about some sectors performing exceptionally well or some geographies. For example, if the US tech companies do super well, then in that case we may get overexposed to the technology sector and to the US geography. So then we want to rebalance our portfolio by selling some US stocks, or alternatively invest in some non-US stocks, and we want to consider how to rebalance our portfolio by moving away from the technology sector. Now, a point to be made is that rebalancing costs money because we're buying and selling, which means that we're paying transaction fees. So as a result, we should not do it too often. So maybe we want to rebalance every few years, but then again, it depends on how the market develops and what our initial investment portfolio looks like. So how can we apply diversification correctly and avoid these 5 common mistakes? Well, we need to spread our investments globally across sectors and across stocks that react differently. We want to avoid over-diversification or naive diversification. We want to consider the full financial picture and invest not only in stocks but also in bonds, commodities, and other assets. And finally, we want to occasionally rebalance our portfolio to make sure that we stay optimized and with our preferred risk-return relation. So these are quite some rules, but now I want to give you some tips on how to make diversification easier. Now, the easiest way to start diversifying is by buying exchange-traded funds, or ETFs. So what is an ETF? Now, an ETF essentially is a basket of stocks or bonds or other assets that you buy all at once. So what I mean by that is the following. Think about our earlier example. Before, we invested 3 times in 3 separate stocks. So we bought the low return stock, the medium return stock, and the high return stock. But these were 3 separate transactions. Now, with an ETF, you can essentially buy a basket of stocks. So this basket already contains these 3 assets, and we only have to buy the basket itself. So essentially, we're buying our portfolio, or our preferred portfolio that we had from the previous video, where we have an 8% return but a low risk level. So that's a very convenient way to diversify easily. And as a result, ETFs are a great way to reduce risk. However, there's some final considerations regarding ETFs. Some ETFs are quite sector heavy. For example, the S&P 500, which contains the largest companies in the US, depends a lot on the technology sector. So if you're buying an ETF that consists of the entire S&P 500, so it's a basket consisting of 500 different assets, or the exposure to 500 different assets, then it may be that you're still quite heavily exposed to the technology sector. Now, some ETFs are geographically concentrated. For example, there's this ETF that allows you to invest in the MSCI World, or the index that consists of the largest companies globally. However, globally, the largest companies are most often from the US. So in this case, when we're investing in the MSCI World, we're actually depending a lot on the US developments. Now, in both of these ETFs of the S&P 500 and the MSCI World, we are also dependent on the very large companies. So in these cases, when we're buying the MSCI World, we may think that we have great diversification. And don't get me wrong, by buying the MSCI World, you start out with great diversification. However, if you start your portfolio and you buy the MSCI World, from there you want to consider how you can further increase your diversification. And maybe you want to consider buying ETFs that consist of stocks that are from different geographies, such as Europe or Asia or other areas. Maybe you even decide to buy some individual country ETFs. Now, in this case, when we're still considering stocks only, we also want to consider how to get some exposure to some smaller stocks or mid-cap stocks. And there are specialized ETFs for that as well. Now, finally, obviously, we also want to consider how to add to these ETFs on bonds or commodities. So in that way, we get the great diversification benefit that we were after. However, when we're buying ETFs, we're not only paying a transaction fee for buying and selling. There's also a fee for maintaining or managing these ETFs, and that's because specialized companies develop them. They develop the ETF and they manage the ETF. Now, as a result, we have to pay these companies a fee for owning the ETF. They may be 0.1 or 0.5% per year, but still it's something to consider when working with small investments. So what are the facts and fictions on the practicalities of diversification? Well, the fact is diversification must be done thoughtfully. And the fiction is, if I own an ETF, I'm diversified. We know from the discussion that we had so far that it's not that easy to diversify. There are these 5 common mistakes that we have to keep in mind. But even then, when we consider these 5 mistakes and we start buying an ETF, we want to consider what is the underlying risk of the ETF, and does this mean that I'm good on diversification, or does it mean that I need to add some other ETFs or to other types of assets to fully take advantage of the diversification benefit? Alright, thank you for watching. I hope you liked this video. If you did, please hit the like button and also consider subscribing to this channel if you want to stay updated on everything related to finance, but you want to have a neutral and academic insight into the facts and fiction. I hope to see you in the next episode. Bye.